Hello and welcome to the fourth edition of our Investment Insights series, Magellan Minutes. Unfortunately, due to COVID, we found ourselves broadcasting via Zoom yet again. These challenging times continue, but we're hopeful that we'll be back in the studio again very soon. My name is Jennifer Herbert, Key Account Manager at Magellan, and in this session, I'll be talking with Ofer Karliner, Portfolio Manager on the Infrastructure Fund. We'll be discussing standout sectors in infrastructure, our approach to ESG and climate change, and finally, we'll take a look at the impact of M&A on the infrastructure portfolio. Thanks for joining us, Ofer.
Thanks, Jen.
Ofer, toll roads rebounded strongly in 2021 on the back of a strong recovery in traffic. Now, I believe your team has actually written an article on this, and the findings prove that toll roads remain essential assets. Can you talk us through this, please?
Yeah, so at the onset of the COVID crisis, people were speculating that the increase in video conferencing and working from home, that flexibility would mean would see a big decline in toll road traffic. And to horribly misquote Mark Twain, the rumours of the death of toll roads has been greatly exaggerated. It's not what we've seen at all. What we've seen is traffic rebound extremely quickly. And there's sort of three key factors that explain why. First of all, commuter trips, so trips between home and work, represent around 16% of total trips for Transurban, which is the biggest urban toll road company in the world. So it's quite small in the context of that business. And for interurban roads, that's roads between cities, that's likely to be a lot lower. Second of all, people are using the increased flexibility that they've gotten from working from home and video conferencing tools to actually change the time that they're going into work. So there's a lot of evidence of what's called peak spreading. That means people are going in earlier or later than they were previously. We used to see a big spike around between 8 and 9 a.m. and then it sort of dropped off materially. What we're seeing now is that peak starts at a similar time but ends a lot later. So people are using that flexibility to do calls from home, do some work from home, and then go into work into the office after that. And that actually is beneficial to the economic value of toll roads. It means you can fit more cars in. Often toll roads are at capacity at peak hours. So the fact that you're reducing that peak and extending it means you can actually fit more cars in over time. The third factor is just the decrease in public transportation usage. So this has been consistent around the world. People are avoiding public transport because of the health concerns. So in November, Sydney saw a 55% lower public transportation utilisation than in the same month in 2019. In London, we saw similar numbers, down around 30% in October, November. Again, all across the world, this pattern's being repeated. That will obviously abate over time as people become, learn to live with the virus, become more confident about travelling. But there will be an element of that is sticky, and that will certainly benefit toll roads in the medium to long term. My colleague, as you mentioned, David Costello, has written an article on this, and you can find it on our website if you want more information.
Ofer, utilities had a tough year last year, as despite solid earnings, they were rather unloved by the market. Then in December, the sector rallied strongly. What was happening here, and did our thesis on utilities finally play out?
The short answer is yes. But we expect that there's still more to go longer term. Now, in 2020, utilities took a hit, much like everything else in equity markets, although it wasn't hit as much in March, April last year, March, April 2020, I should say. It rebounded, but as the market took off in sort of November post the vaccine announcements in 2020, they were left behind, and that's despite very, very robust earnings. And when I say robust, we saw one company in our portfolio in 2020, one utility company, downgrade their earnings, and that was National Grid, and they said they'd actually make that up in future periods. In 2021, only one utility in our entire universe has actually downgraded earnings. So again, very stable, very reliable, very robust earnings. The problem is stable and robust isn't very sexy when the market's off to the races, so they really got left behind. What we saw in December was markets all of a sudden become worried about Omicron, they became worried about inflation, they became worried about economic growth, and all of a sudden there was rotation to defensives, and utilities are extremely well placed to deal with that. They have inflation protected cash flows, they have little economic sensitivity, so we saw them rally quite strongly in December.
We've discussed at length the effect of inflation and subsequent interest rate rises on our infrastructure holdings in previous series. Inflation has not abated. Are you still confident in your inflation protection?
Yeah, absolutely. We haven't seen anything so far that would make us really concerned. Toll roads have been able to pass through toll increases with little fanfare. Same with utilities, have been able to pass through their costs with little issue. Inflation protection is actually one of the really attractive features of the sector, and we think that will persist through time as long as we define that universe correctly, which we're very conservative on, and we've talked about at length. You will get inflation protection from a well-defined infrastructure universe.
Okay, on quite a different tangent now, we're frequently asked about our portfolio positioning with regards to ESG and climate change. So how do you consider these factors in your stock picking and portfolio construction?
Yeah, so we focus very much on the impact to cash flows from ESG issues. So how will the cash flow series be affected? Now our portfolio construction has sort of three parts. There's a valuation part, a quality assessment part, and a macro overlay. And the first two is where this is really dealt with. So from a valuation point of view, to the extent we can estimate the impact it has on cash flows, we try and put that through our modelling. So for example, we've done extensive work looking at asset stranding risk across all our asset classes. So if you look at, let's say, natural gas distribution companies, there's a risk that with a reduction in natural gas usage through time, that obviously the economic impact will be significant on the valuation. There's a lot of uncertainty over that, so the speed of that decline, whether you use renewable natural gas in the feed, which makes this last longer. Can you retask that with hydrogen, for example? But what we've done is actually reduce the duration of excess returns that these companies can earn as a way of trying to capture that risk in the valuation directly. We also recognise there's a bunch of risks that you can't directly model, and that's why we have our quality scores. And actually 40% of our quality scoring process relies on ESG factors, and that feeds directly into our portfolio construction. So you score badly on these factors, it makes it harder for us to own the stock.
Finally, Ofer, we also saw a lot of M&A activity last year that had an impact on the portfolio. Can you talk us through the deals and how that had benefited investors?
Yeah, there's sort of four deals that really impacted the portfolio. So ASTM, the Italian toll road company, was taken over by its majority shareholders, as well as Sydney Airport was the biggest one of the year. Again, Australia saw three major takeovers: so Sydney Airport, Spark Infrastructure, and AusNet. On average, the premium to the end-of-share price was around 38%. So obviously, investors in the fund benefited from that uplift in share price. Now, longer term, it's obviously disappointing to see these assets go. They're all high quality assets, but ultimately kind of reflects the fact that the unlisted market is willing to pay more for these assets than the listed market.
Ofer, thank you so much for sharing your insights with us today.
Thanks, Jen.
And thank you to everyone for watching. If you have any questions, please don't hesitate to reach out to the Magellan distribution team, and do feel free to share this update with clients or colleagues as you see fit. Take care and stay safe.